April 7th, 2025, and the financial markets are still reeling from one of the ugliest single-day drops in years. On April 3rd, the S&P 500 cratered nearly 6%. The Dow plunged over 5%, and the NASDAQ took a 6% hit. Some of the biggest one-day percentage moves since the 2020 COVID crash. Bond markets flipped too, with the 10-year Treasury yield sliding as investors fled to safety. And here's the kicker. This could be just the beginning of the pain. We're caught in a web of government upheaval, trade wars, and economic cracks that are only getting wider. Today, we'll break it down and show you how to protect yourself or even profit as the storm worsens. Let's set this stage. On April 3rd, the S&P 500 plummeted at 5.97%. It's the worst day since March 2020, 11% nosedive. The Dow shed 2,231 points, a 5.5% drop, and the NASDAQ fell 5.82%. That's $2.4 trillion in market value wiped out in a single session, more than the GDP of most countries. The bond market wasn't spared either. The 10-year Treasury yield dropped from 4.2% to 4.05%. That is a sharp move, signaling panic buying of safe assets. Historic drops like these are big. They're outliers. Think 1987 or 2008. But unlike those moments, the bleeding hasn't stopped. Markets are down again today, and volatility is spiking. Why? Man, this is a perfect storm of policy shocks and economic fragility. Let's untangle this mess. This isn't a one-day blip. It's a crisis that's been building, and it's far from over. First, the Department of Government Efficiency, or DOGE, is slashing federal jobs. They're gutting agencies. Their mission is to shrink government bloat, but the fallout's messy. Businesses tied to public spending are freezing hiring, and consumer confidence is tanking as workers brace for layoffs. With DOGE's cuts accelerating, entire sectors could face a squeeze, dragging down growth even further. Then we've got Trump's tariffs. Call it Trade War 2.0. He slapped a 10% baseline tariff on all imports, plus 25% on Canada and Mexico, 20% extra on China, just to make sure, and reciprocal levies on dozens of countries. He says it's ripped off the U.S. for years. China retaliated with their own 34% tariff on American goods, and the EU's prepping its own countermeasures. Economists are warning this could slash global trade by a quarter, jack up prices, and push inflation higher just as growth stalls. Markets are pricing in that pain now, and every new tariff headline sends stocks lower. Now let's talk Biden's shadow. Critics argue his administration papered over fiscal rot, the deficit soaring past $2 trillion a year, national debt hitting $36 trillion. They lowballed projections to keep these markets calm. Truth spilling out. Remember, when Biden's team dodged calling 2 quarters of negative GDP a recession, they leaned on jobs data to spin the narrative. But with growth now faltering, Q1 2025 GDP trackers are flashing red. That redefinition looks like a bad magic trick. Under it all, the fundamentals are crumbling. U.S. consumers are tapped out, credit card debt surging, and more households can't even cover a $2,000 emergency. Corporate earnings are cracking under higher rates and tariff costs. Globally, China's stimulus is fizzling, Europe's distracted by defense spending, and emerging markets are wobbling. The Atlanta Fed's GDP tracker hints at a contraction. Really? Wow. And Wall Street's recession odds are climbing. You're just waking up to this? Moody's says 40%, Goldman's at 35%. This plunge wasn't the end game, it was the opening act. I think it's more like 95%. Here's why things could get uglier. Tariffs aren't just a U.S. problem, they're a global problem. If China, the EU, and others keep retaliating, we're looking at a trade spiral that could choke supply chains and spike costs for everything from cars to groceries. That's stagnation territory. Slow growth, high prices, DOGE's cuts, meanwhile, are rippling. Less government spending means less economic fuel, and businesses are already pulling back on investment. Consumer sentiments in a free fall. Surveys show Americans haven't been this pessimistic since the 2008 crisis. If spending dries up, that's 2/3 of the economy on ice. Corporate debt's another ticking bomb. Firms that binged on cheap loans are now choking on higher rates and weaker demand. And don't forget, the bond market yields are volatile, and any hint of more Fed rate cuts could signal deeper trouble. The market's down 12% from its February peak, and technical indicators like 0 S&P 500 stocks at 20-day highs scream exhaustion. If trade talks stall or Doge doubles down, the next leg down could be even brutal. So how do you survive this? First, shore up your defense. Cash is king right now. Keep some liquid to ride out this storm. You need to pay down debt. Don't let high interest rates or a job scare catch you over leveraged. That's the key. Don't over leverage yourself. Want to play offense? Shorting is an option. Target overvalued stock. Options can amplify those gains with less risk. Buying puts lets you bet on further declines without betting the farm. But it takes a little bit of education and knowledge to do this. Study the charts, start small, and never risk what you can't lose. The goal is staying flexible. Markets punish the cocky and reward the patient. If you're not sure where to start, knowledge is your edge. Keep learning to stay ahead of the curve. If you're ready to limit your losses or turn this downturn into an opportunity, I got your back. Hit me some comments, subscribe to Kevin Navigates, drop your thoughts in the comments below. What do you think's driving this mess? I'll see you on the next one.